this is Cece with a special edition of the Orbit. We're going to make this a new running series where I talk to some traders I have some respect for, some traders that I follow on YouTube and other places, and try to get their insight on their particular styles of trading, how they got into that style of trading, and sort of tie it all together in an options focus where we can kind of go back and forth and discuss some of the nitty gritty and things that you out there as an audience might be looking to do or might be more curious about. Of course, this is for educational purposes only, and get a little bit more familiar with other styles of trading. So I want to introduce my guest, Logan Lajiness, and you can find him on YouTube, Logan Laj. And he's interesting to me. He's someone I've been following for a couple of years, actually. And because his channels are primarily options focused, which is, of my interests. And when zero TTE in particular started emerging as a real popular trading style and a real popular part of the options market, Logan was one of the first channels that I saw covering that. And it was an interesting way that he covered it. And it was like sort of a curiosity. Let's dive into this. Is this different? Like, is it different this time if you shorten the duration to 24 hours, under 48 hours, and you get down to hours? Does that change anything about options trading? And so I want to introduce Logan. And I guess one of the places I wanted to start was, sort of tell the audience briefly about your history. How did you get into trading? How did you particularly then, I assume you were doing something with equities, like most people. And then how did you get into options?
Yeah, absolutely. So I appreciate you having me on, number one. Yeah, so we'll start with getting into trading. So I've been trading for just over 6 years now. I started in 2017. My interest peaked with Bitcoin back in like the big bull run. So I was working at a restaurant and a guy came in and I was like bussing tables and kind of like cleaning around. And he asked me if I was like into Bitcoin or investing or whatever. And I was like, no, not at this time, but I really do want to get into Bitcoin. He's like, I bought two Bitcoin for 2 grand and they just went up to 20 and I sold them both. It was like that crazy bull run end of
Yep.
2017. And I was like, no way. And then the next week I saw him and he said he got back in and then it started to go down and he sold out. And it was just funny to like see the psychology back then. I was like, wow, he's still messing with it, even though he did so well,
Yeah.
So that's like what really, really piqued my interest. And, I really started diving in 2018 was like my heavy year of just learning. Like I remember buying shares of just companies to understand my psychological perspective on like if I buy $1,000 worth of this share, how does this make me feel? And then, I really got into options trading at the end of 2018 into early 2019. And a lot of my strategies back then were just like covered calls. I bought a lot of Tesla shares and Apple shares that I end up selling for like 500 to 600%. Apple ones I think were 300%, but that I picked up through like 2017, 18, and then they went nuts up until about 21 when I sold them. So, I had a couple investments in there as well that did really well. So I was like, wow, even more money for options. And my main sole focus, because I was just kind of messing with them here and there, doing a lot of covered calls. I would do like small call debit spreads. I started to learn about calendars a little bit, and doing a lot of longer expirations. Like, I was doing months out of time, like 2 months out, 3 months out. Just very, a lot of leaps. I remember buying like a lot of Beyond Meat leaps back in that time, and they were actually doing pretty decent for a bit.
Oh yeah.
So a lot of my, I spent up until about, I think it was mid 2020, right after we bottomed with the COVID crash, when I started to buy naked options. And I actually did really well with those because I bought a lot of the airlines. And my idea was like the psychological side of everybody thinks these are going to keep dropping. And I just want to be a little counter with this and go 3 months out. And I remember getting like 9 grand worth of spirit options for like 3 months out, and they doubled in a couple weeks. So I sold them. And, as I kind of went through into the end of 2020 and volatility lessened, right? We started to fall. That's when I started shifting my strategy to basically credit spreads only. So the idea now that I had enough capital to where I could generate a few $1,000s a week. And, if I really focused on the short-term durations, I could be more active trading, but also not, trying to catch every single move, trying to catch the beginning of a move and ride it out all the way, right? Like I found that I was just much more mentally sound when I was trading that way. So throughout all of 21, throughout all of 22, and even all throughout this year, I basically made the full shift to short-term credit spreads. And I found like mentally it gives me the most freedom when it comes to trading. I don't have to get too caught up on what's going on in the news. There are a couple events I like to skip as well, like FOMC, CPI. So a lot of things I try to just not add risk for.
Yeah.
But overall, I just found like, that's been my best success because the market's been able to go up and down. We went through a bear market period, and I still was able to do better than the S&P throughout that time. So I don't risk very much in my portfolio per trade. My kind of trading is, I like to risk like 4 to 6 to up to 8% on a trade. But also while I'm doing that, I'm hedging to offset that position already. So, and then I take like 200 trades a year. So even if I lose on a handful of them, my main focus is just long-term success and just to have a positive equity curve throughout the end of the year. So that's always been my main focus. And, I think a lot of people got beat up in 22. The market ended up, well, we ended down 9% on the year, like from the start to the finish. So that's a pretty hefty move. And at one point we were down like 23% at the low. So
Right.
pretty hectic move, but that's where, like, for me, really getting the experience in like the market that only goes up, the market that only goes down, it seemed, and then this year, which has been a good mix, has really helped me stay like as proficient as possible. And my interest really came into like the 0 days for all of 2022 because the market was moving 50, 60, 70 points a day nearly every session, right?
Right.
So that really piqued a lot of my interest, was just like, wow, I could get in a trade and within an hour be done for the day, but also look at all how much less risk I have to have on, versus putting on a whole bunch of risk and then having to deal with the moves up and down if I was to trade, any other format. So the credit spreads I just liked. I could be like risk 5 grand to make 750, 5 grand to make 1,000, and even if I collected like $500 in 30 minutes, I'd close that thing out, and you could always reset and look for the next setup. So it's nice because it just keeps me a lot more, like I said, mentally sound when I'm
What's
trading credits.
interesting is that journey you went through is a very interesting one because my first job out of college was I was an options market maker, and I had no interest leading up to that point on the stock market. I was not a kid that grew up reading the Wall Street Journal or anything. I didn't know what a bid ask was when I took that job, but it was essentially I went to school in Philadelphia, and we used to go to Atlantic City late at night after the bars in Philly closed. And a buddy of mine interviewed with the firm I ended up working at, and he's like, "Oh, you should go check these guys out. It's basically just numbers and probability and everything that we're trying to do when we're gambling." And
Yeah.
what's interesting is once I got involved in that job as a career, I still to this day, like I don't have CNBC on all day. I don't, I'm not reading earnings reports or anything like that. But the things that do interest me and have always interested me are A, the math side of it and the probability and all that sort of thing. The other is
Yeah.
the psychology. And the psychology, if somebody asked me what skills that I picked up, as a trader, or if I started a derivatives trading firm, it's obviously math helps and all, but the psychology of it all is very important. And that meta-analysis you're doing of yourself constantly, those were the best traders. The non-emotional traders, the ones that even, people are like, oh, I'm a contrarian. I'm like, well, that's an emotion. You're expressing an emotion. You need to be smarter than the crowd all the time. And you should be
Yeah.
very careful about that, right? There are times to be contrarian. There are times to be, consensus. I'm a big defender of the consensus a lot of times. And we'll get into that with, sort of zero DTE trading and the expected move and things like that. But that psychology of trading, then it's funny that you transition from, seeing a bunch of manias and trying to sort of, psychologically study that, and probably meta-analysis of your own emotions during those periods, and especially when something's going wrong against you,
Mhm.
to turn that into, oh, you know what? It fits my own personal psychology to be a credit spread trader. And that's not for everybody. But I can tell you, when I was doing this professionally as a market maker, I always leaned towards being short premium. And I even tried to be short premium with low volatility. And the reason for that is a mix of laziness, which is, if you are long premium as a market maker, you are constantly coming in the morning and facing a massive amount of decay from theta that you have to hustle all day long to cover, just to even cover that theta and not lose a ton of money.
Yep.
Psychologically, I also discovered, and I don't know if this was from being an athlete who was, missed the game-winning shot and being able to get over that very quickly, but the psychology of being a credit, in your case, a credit spread trader, you basically have to look at it very like risk reward and very unemotionally, and
Mhm.
say, this trade is going to work out more often than not, but then sometimes it's really going to blow up in my face, and I need to be able to handle that psychologically, right? And blowing up in your face, you can cover for that, right? You can do defined risk spreads, you can do all of those sorts of things. And then the other part about options, which is really cool, is I think you can use options in a way that I always refer to it as allowing you to sleep at night, right? So if you are constantly making what you feel are bad decisions and they generally are at capitulation moments, whether that's in the market down 20% or some mania to the upside, if you find that you are that person that is constantly making the wrong choice at those moments, then
Yeah.
options can really help you prevent from making those bad choices at those moments, right? So that's the other thing I love about options is, worried about right now, the Nasdaq's up 45% on the year, and you're long a bunch of these, cloud stocks and AI stocks and chip stocks. And it's like, I think they could keep going higher, but I'm too nervous. It's like options can help you, so that sort of thing I love about that. And then the fact that you got, your time frame shifted to zero DTE, and from like a real income perspective, that takes a certain type of psychology, which is, I'm not going to try to hit a home run. I'm not going to, a lot of people, it's sort of like the keeping up with the Joneses, right? Psychologically, which is, and I've actually read studies on this. People not making money, it's a more powerful emotion than actually losing money, right? So people
Wow.
will look at whatever the stock is today up 20%, and they will feel a more negative feeling about having not participated in that rally than had they been long a stock that went down 20%, right? And so
Yeah.
it's that sort of like, I can't believe other people are making money and I'm not, right? And I feel like that is something to absolutely avoid as a trader. So I kind of wanted to turn the conversation to get into, your particular style, because I always find this fascinating. I'm always asking people, particularly like zero DTE, like I'm still trying to figure a lot of this stuff out, right? It's fairly new. It's not
Yeah.
something I did professionally, right? All of our expiries, they, were a week out, 3 weeks out. I was even back in the day where it was every 4 weeks, right?
Wow.
So I wanted to kind of get in, and I'm going to do a little screen share here, and we're going to go into options AI, obviously, and just talk a little bit about, right now, can you see my screen?
Yep.
We are looking at a expected move chart. We are on the 1 month view. And I kind of want to zoom in a little bit.
Sure.
Right now, we've got like a 2 day view. We're coming up to the close on this day. So the expected move for the rest of the day is basically zero. But so let's sort of use tomorrow's expiration as an example. And again, you just mentioned tomorrow is CPI, correct? Is that before the
Yep,
bell? Yeah,
that
so
is.
this would probably be a day or at least a morning that you would be very careful about, right? And so what we're looking at is we're looking at a 0.6% expected move from the options market. And just to explain that, this is not the options market saying that the SPX is going to move 0.6% tomorrow that you could bet on. It is basically saying this is the consensus of options traders in the market for it's where the buyers and sellers have met. And buyers are saying, I think it's going to move more than 0.6%. And sellers are saying, I think it's going to move less than 0.6%. And so the way I always explain this is it's very similar to a point spread in a football game, right? So
Yeah.
I forget who's playing tonight. I think the Dolphins, right?
Uh,
So if the
yeah.
Dolphins are favored by 7 points, that is not somebody just like the spread starts at 7 points because a bunch of people do some research, but then it moves with buyers and sellers, right? And if there's a bunch of people that think the Dolphins are going to win by 14 tonight, that spread will increase and it will that uncertainty will increase. And that's the same thing the options market is doing right here. So it's the options market is saying there's a CPI tomorrow. The expected moves most of the other days leading up to this have been about 0.4%. And
Yeah.
tomorrow it's like 0.6. It wouldn't be shocking to have it up towards 0.75%. Back in the day when this was the most important news of the month, back during that inflation scare, which was real, but you get my point. It was, you would see these expected moves like this would be like 1.5%, right? And it was
Yep.
basically like, the Dow could tank 600 points if the CPI is hot, right? So we're looking at the 0.6%. And so if you were approaching, let's say, and let's even take the CPI out of it. Let's say that this
Sure.
was just a normal day and it was a 0.6%. You and I have talked about this a little bit, but
Yeah.
what time of day are you checking in on the market? And how are you thinking about your time frame? Is it 1 hour into the trading day, half an hour into the trading day for the rest of the day? How often are you looking out to tomorrow's close, and how often are you looking out a week or 3 days or something like that?
Yeah, so I track a few metrics. First, I track basically what the expected move was from the previous day's close. So if let's say we have right now a 0.6%, let's say the market closed right now, no matter where we move tomorrow, I'm going to track that as my metric. So
Mm-hmm.
for that trading day, because what we found is, we did a whole case study on every single expiration day since 2018. And we found that on those expiration days, they seem to be coming in at about a 63% rate that we stay within the expected move,
Yep.
which should be closer to 68%,
Yep.
just from a like statistical bell curve standpoint. So we found that, okay, if the odds are helping us, that if we stay within the expected move, we already inherently have a better chance of winning, right? If we're playing our spreads outside of what's expected. You'll see it a lot. Last week we saw it 2 times where we actually hit the expected move band, and the second we hit what was expected, we shot right back down.
Yeah.
So almost like a mean reversion style.
Mm-hmm.
So for me, I'm always tracking the previous day. And then we actually had a really good setup last week where the 45.90 was 2 times the expected move to the upside. We tracked it to where it's about 93% of the time we stay within 2 times the expected move.
Right.
So I'm able to set up a spread that returns a 20% yield on something that wins, right? 93% of the time, or only loses 7% of the time. So if I'm getting a 20% gain on a 7%, right, like inherent statistical edge, I have a 13% edge on that trade.
And let's
So,
pause right there because I think
yep.
this is an interesting scenario. And I talk about this in the morning orbit that different, there's different trading styles. Obviously, you can just basically say, all right, this is where the stock closed the day before. I am going to do an iron condor at whatever delta outside where the stock closed, whether it's 20%, 15%, even some people do 10%. Um, and then you're basically saying, I've given myself enough space that whatever this open to in the morning is, let's say the expected move is 0.6% and your strikes are at 0.7%. Whatever this
Yeah.
happened, let's say it opens up a 0.5%. I am still going to steadfastly hold to that, what was the expected move from the day before. But what you're saying that you like to do, and you're essentially describing legging into credit spreads, because
Yep.
you might take that first, let's say the expected move was a 0.5%. Let's say the market opened up a 0.5%. You're actually selling that extra half a percent above, and you're saying, and at that point you're getting probably 20 deltas or just under 20 deltas. However, you're saying that 90% of the time, or 90 whatever stat you just said, the market does
Mhm.
not continue higher and go up more than 1%. Did I just describe that correctly?
Yeah, 2x
Okay.
the EM. So two
Yep.
whatever that happens to be, because some days, right, if it's like a 50-point expected move, your 2x is going to be 100 points away.
Yep.
So, but yeah, that's exactly my thought process. And to me, as somebody who likes to follow pricing, anytime I can get really good credit at 2 times the expected move, to me, that's a no-brainer trade. And the only reason I say like a no-brainer is because the statistical edge is just so heavy in your favor because it doesn't happen very often,
Right.
right? Where you'll get a move to 2x what's expected. Doesn't mean that it can't happen very often. It just doesn't really happen that often.
Right.
So, if I was somebody looking at selling right now into tomorrow, I always tell people if you're trading credit spreads, unless you have a really good hunch on direction, I always tell them use the expected move as like your baseline. Like
Right.
if you are within the expected move, expect to get tested is what I like to
Mm-hmm.
say, right? So no matter if you're like, because I see this all the time where the market gaps up and people chase that move and they
Oh
look
yeah.
for the continuation, and it literally could open at the upper EM band, could fall all the way to the lower EM band and bounce a little bit, but it still catches their trade. And then they go, what happened? I'm losing all this money. And I'm like, you're playing within the expected move.
Right.
So you should expect for those trades to get tested. So that's what I always try to tell people when it comes to trading and anybody who's getting into like short-term durations, because, tracking that previous day expiration, if you're still, if we're staying inside the expected move, which it should be about 70% of the time, but it's a little, like I said, it's skewed closer to like between 63 and 64%.
Yep.
That's still like you're looking at almost 7 out of 10 trading days staying within the expected move. That means, if you catch one of those or two or three of those trades per 10 days that are way, way out of the money, or sorry, like push way, way, way further than was expected, then you can just continue to go further out of the money, right? And collect premium around it. So my whole entire strategy is just based around like putting yourself in the best situation for the least amount of management. And then
Yes.
if you do need to manage, I don't use strict stop losses because I also know that premium's going to move all around. And
Mm-hmm.
credit spreads, right? If you find yourself sitting there in a spread and the market goes up 15 points and then drops down, like there's so many people that get chipped out really quick before it goes in their direction. So I like to roll and hedge to where before the price gets in the money, I'll roll that to either the exact same strikes for the next expiration and collect more of a credit so that now my edge is even bigger. So like from a how much credit I've received standpoint. And then I look at beginning to hedge on the opposite side.
Mm-hmm.
So if the market continues to push against me, I've collected even more premium from the put side. If you use the same expiration, it doesn't require any additional collateral because you can't lose on both sides.
Right.
So that's a lot of my strategy right there. And then my whole goal, like I said, I like to 6% portfolio risk is right around where I like to do these. So if you had $100,000, I like to do, risk 6 grand to make like 1,000 to 1,500.
Right.
And then if you win enough, right, you should be able to walk away with about $3,000 a week or so. Um, if the market, of course, goes in your favor, your setups are good, and then you're going to lose, right? Like
Yep.
even if you collected $1,500 5 days in a row, that's $7,500, but you should expect to lose probably about half of that in that process. So
Mhm.
for me,
And
like,
if the market goes wild, that can totally flip, right? And so I
yep,
talk about this a lot on the channel. When the VIX is 13 or whatever we're at right now, 12 and a half, you are selling really close to at the money, but the VIX is 12 and a half for a reason. It's not moving much, right? And you're not getting rewarded with a ton of premium that you're selling, or you're having to do it much closer to the money than you are comfortable with. However, it's going to work out more times than not, right? It's going to
yep,
scare you, like as you say, during the day, but it's going to work out more times than not. When the VIX is 35, you're selling crazy amounts of premium really far out of the money and stuff like that. But man, the VIX is 35 for a reason, and it will that kind of sustained volatility. It doesn't last long, but you could be wrong for two straight weeks, in a really wild market. But then
yep,
you start to get the advantage of that premium starts to collapse. You're continuing to do that. You're selling really high vol, right? So
yep,
it's just sort of an interesting scenario, is that like even with low volatility, you can be a premium seller and it's going to work. It's going to work. You're going to know when it stops working, because you're going to see, the market's going to start to go crazy. The VIX is going to be over 20, and you've got to kind of like reassess exactly, your overnight risk, your gap risk, all that sort of stuff. You kind of have to shift your mentality. I
yep.
want to get into something really, so I just teed up a credit call spread at about, the 20 delta level here. The short strikes at about 20, yeah, 20 deltas. And
Cool.
so let's say the market opened up, and it opened up, what are we up right now? 0.3%. And then you
Yep.
were doing that 2x of the expected move type strategy. And then let's say you got your move back and the market went red, right? And it's, I don't know, noon Eastern. Are you then, when are you looking to close that credit call spread? And what are your kind of like general back of the napkin rules there? And
Yep.
then are you then legging into the entire condor by selling a credit put spread? And where are you placing that thing?
Yeah, great question. So, generally, I'll leave the call credit spread open if we do gap down like a decent amount. So by a decent amount, I mean at least half of what the expected move was. So if
Right.
it's 30 points and we gap down 15, now I just have, you know, at that point, like 50 points of runway from getting tested. So if for whatever reason we shot all the way back up, right? Like at least at that point, I would have a lot of time to manage and get out early for whatever profit that I have. So I don't really close. Now I'll do it in like volatile markets. I'll like
Yeah.
chip stuff for 10 cents or 5 cents.
Yep.
But you did ask a really awesome part after, I do look at getting those condors if I get the initial move right.
Yes.
So, and the other thing I do for that is I basically use what the expected move was for the previous day. And then I also take a look at the market internals. So the advanced decline, I like to see what that's doing. If
Mhm.
we're like negative 2,000 or higher, I stay away because of just the mass public and institutional selling that we're seeing overnight. So I'll stay away completely from the put side, or, if we're plus 2,000, I stay away from the call side. And I kind of use that as my parameter to where, like, if the advanced decline's neutral, like a day like today, I didn't even have to think about closing my spreads, right? Because it's completely neutral, or at least it was before we got on the call, where the advanced decline might be at 100 or negative 100, to where
Right.
there's no more buying than selling going on.
Yep.
For that reason, right? Like I'm also like you, I don't watch the news at all, like
Right.
no financial news. And because to me, it's like no matter, even if you find the reason for why the market's crashing or why the market's flying, I still believe that what's priced in and just following the statistical odds of what we're doing, you can do very well. And you talked about like the point spread of a football game. People always mention like, all the good sports cappers in the industry, but ultimately Vegas, right, is like the ultimate sports
Yeah,
capper, right? Like you wonder, you're like, why are the Chiefs only favored by 5 points against the Packers and then the Packers win,
yeah,
right? Like stuff like that. So, and I kind of believe that with the markets too, where I really do think everything's so properly priced
yeah.
that no matter what the news says or does, if you just track the expected move and how we react to the EM bands, like the top or the bottom, you're going to find that like no matter what the world's doing, we come back to that, that it's kind of like that mean reversion, right? Like we always come back to that average. And so that's kind of like my setup for that stuff. And if we
I'm like, and I'm not an efficient markets type theorist or whatever, and I think markets often get things wrong, and they only get
Mhm.
them wrong, like for a quick bit of time. When I look back historically at a lot of, even manias, I'm like, it made sense at the time. And so even, like I think back to like the last couple of months, like there've been so many people fighting this rally. And I
Yeah.
was looking at that rally the whole time, and I was saying, I was speaking about it on the orbit that there were some very fundamental backdrops in the options market and the equity market that made sense once that rally, especially once that rally happened, for it to be like a slow grind higher into year end. People are still like, are we going to get a Santa Claus rally? I was like, dude, that started back at Halloween almost,
Yeah,
right?
that happened a while
It
ago.
happened a while ago and we got it. And it was this slow grind higher and all. And to me, it made perfect sense. And every time I heard somebody like fighting that rally and especially that slow grind higher, not only did I, sort of try to remind them of the conditions of the market and what a VIX at 13 actually feels like. But the
Yeah.
other thing was, think about the backdrop in the story. Like investors got that pretty correct up until now. Like now's the next chapter. We don't know what comes next. We never know what comes next. But at the time, people were buying stocks. We had just come out of a period where everybody thought interest rates were going to 15, right?
Yeah.
And of course, you were going to sell stocks during that because we didn't know when it would end. And then when it started to end and yields started to reverse and the Fed started to back off, all of a sudden you're looking at the market and you're like, clearly it's a buy, right? There's very
Yeah.
little risk for the next few months because we're sort of in this Goldilocks period. How that ends, we have no idea. How it ends in 2024, especially, we have no idea. But investors had that kind of right, and I'm always fascinated by that sort of thing. Is that like, I am more often consensus than I am contrarian, and I'm
Mhm.
contrarian at those moments where it's so clearly at the end of a cycle, and you can sort of spot those, like the end of a sell-off, things get nuts. The VIX goes to 40. People, every headline you read is that like the Western economy is done for the next millennia. Like those moments are so obvious. And the same thing happens in the manias to the upside, where it's like, you start to see a lot of people take victory laps, right? Like that they've been right and that they're never going to be wrong again. Like those kinds of psychological moments are always fascinating to me.
Same
But
here.
in the meantime, it's like, the price is the price. And you've got to think about this in probability. And you kind of got to analyze the backdrop conditions of this market. Clearly, right now, we are having this conversation at very low volatility, but even lower realized volatility in the market. So
Yeah.
if you are a credit spread trader at this moment, you are selling really low vol, and that's not going to last forever. Eventually, you're going to get your face ripped off.
Yep.
However, I mean, like in a day, I mean, however, up until that point, the market is barely moving. And you are going to be right a lot in a conditions like this. And you are, when you're a credit spread trader, you are not, unless you're going out 3 months, that's vol trading, right? When you're trading zero DTE and 1 week and even out like a couple of weeks out to a month, you are trading an expected move versus realized volatility. That's all you're doing. You have break evens of trades, and the market can either stay within those areas or they can go and violate them to the outside. And if you set up your risk reward correctly, then you are going to be right more days than you're wrong. And then those days that you're wrong, you know what it costs you, right? And so that's how I sort of think about this. And one thing that's really fascinating when you and I talk is you kind of have this community of, where you guys are all kind of like bouncing stuff off of each other, right? And I think you've even mentioned to me sometimes in the past where somebody, like on one of your groups, like on your Discord group or whatever, is like, this guy nerded out and went back and studied 2 years of data or 10 years of data, and he brought
Yeah.
this to the group. And just talk a little bit like about that in general, but then also, if you have any specific examples that you can remember where somebody just was like, oh, we did, you'd mentioned the 93% thing earlier, but that kind of stuff is really fascinating. And it's kind of that, it's the positive version of groupthink, I guess.
Yeah, and I'm going to share my screen real quick if that's
Yeah.
cool. Um, so this portion, and hopefully my Discord notifications, I
Yep.
can mute them if they go nuts, but usually it's pretty calm. So we have this SPX 0DT entry guide, which is like the only thing I have quick linked in my bookmarks right up here tab. So for me, Vance actually came up with this. And Vance is on my channel quite a bit, and
Yep.
he's been a data analyst for over 25 years. So this guy is like top tier on what he's doing. And I've been working with him since, 2020.
Mm-hmm.
So with Vance, he put this spreadsheet together, or not, I guess it's Google Sheets, but basically it's a 0DT entry guide where these are our possible entries for strikes on the put credit side. We have our possible strikes on the call credit side and the reasoning for them. And then we also have the odds-based moves on the left. So here are the statistical odds of a 1% down or up move is 72%.
Mm-hmm.
So he put a minimum credit as if you're only trading based off of odds, this is the minimum credit you would have to receive to have at least a break-even strategy.
Right.
So if you were somebody who said, you know what, every time that the market gets to 1%, I'm going to do an at the money spread where I'm risking, 250 to make 250, you're going to win 72% of the time historically, right? If you use historical results. But at the same time, right, 72% of the time it's out of the money. So you have that 22% edge,
Right.
right, on the markets. So you're getting a 50% return. So, that's one thing that's really cool about this chart is when you're looking at setting trades up like that, you can go in and say, what is that absolute minimum credit if I'm doing only odds-based trading?
Right.
And this is what I mainly use it for understanding what's our EM high and what's our EM low. And this was for today, and we're still within the expected move.
Yeah.
We haven't even touched the high or low end side today. So, I like looking for trades around that 2x the EM if we can get premium there. And you'll find most of the time when the EM at close is like 22, unless we fall, that's going to be even lower at close. But this is going to stay respected closer to the bell curve if you take that actual at close value. So
Mm-hmm.
that's what I'm always looking for. But
Here's an
yeah, this,
interesting thing. This just reminded me of something, and I should do a video on this or something.
Mhm.
But the the probabilities versus the minimum credit, essentially that you're willing to do this for. One of the things that happens that's interesting in options is out to the tails. Of course, you could probably find something in SPX that you could sell for a 99% probability of profit. But you're not getting paid very much to do that. But the other thing, like, let's not make it such an extreme example, but like, let's say you were selling something, let's just take like a SPY condor or something that you were selling at a really high probability of profit over 90%, but you're selling it at like 7 or 8 cents on a dollar, right? You basically are doing such a binary choice at that point because you are never going to be able to close that trade, right? So
Yeah.
you are basically saying that I'm taking this to expiry because even if you were correct, you probably are not going to have many opportunities until like the last day or the last hour of trading to ever take that off for less than 8 cents. And
Yeah.
more likely, you're going to have been correct and you turn around to go buy that thing and it's still 10 cents or whatever. And so that's the other thing, like I think a lot of people don't realize is the farther you go out on those tails in probability, I mean, A, the less liquid it is, just from like a straight up market standpoint, but B, the less liquid you are, right? When you're selling something at 20 cents, like a credit call spread, or you're selling a iron condor at 35 cents, the range of you having to take it off at a loss percentage wise and the range of you trying to take it off for a profit, it's a much closer, 35 cents. If it starts going wrong, you probably can get out at 55 cents or 35 cents and it's starting to go correctly. You probably can get out for 15 cents, a lot, right? A lot of times. If you're selling something at 8 cents, you are riding that thing do or die until expiry. And so that's the other, it sort of reminded me of like, what am I willing, the old term is picking up pennies off the train tracks. Like that's the other aspect of that is not only are you not getting much for the risk, but you are, you don't have that same flexibility within, from when you put on that trade to expiry, you don't have the same kind of flexibility.
100%. Yeah. And that's one thing I try to mention a lot on my channel is um I think everybody really gets into the iron condor game at one point because they're like, I can make money on both sides and double my income.
Right.
Not like you said, you just sit with that trade on,
Yeah.
because if one side's winning, but you added the other side and that one starts losing,
Right.
you're really going to spend 90% of the time upside down. So
Right.
I really try to focus to just have one side on and just
Okay.
really
Yeah.
have a thesis for that one side, because that's always been, even if I'm wrong, like, hey, I was wrong. But like, I think when you're in a condor, it's hard to accept a loss because you never really had a thesis to begin with as well.
Right.
Except maybe like
It's
most people,
straight math.
yeah.
It's straight math. Right.
So,
Yep.
so that's kind of like my perspective on the Condor side as well. As I'm like, I used to like it a lot because I was like,
Yep.
oh, you chip shot this and that,
Yep.
and looking into it, you can do a little bit more efficiently. But more often than not, I'm sticking to just one side and
Yep.
just trading my ES levels. And
Now, let me ask you this with that. So we
yeah,
went over an example of the market open and higher, and you using that momentum in the market for a potential mean reversion and selling, from the days before expected move, right? And so you're getting paid because you've got your initial up open, right? However, like over time, you are fighting the trend of the market, correct?
yeah,
And so where do credit, because I always say, and I think I have a video of this on the YouTube channel where I discuss, kind of like the wheel strategy and, a potential to do like a wheel 2.0 strategy using credit put spreads and then credit call spreads and kind of like doing that. And what I think of the way I start that video is by saying the reason the wheel strategy works is it's and it doesn't necessarily always work, obviously. And then people get into trouble, and that's really what that video is about. But the it takes advantage of a couple of things in the market that are really important. It is short premium, right? So you're selling credit puts or credit put spreads in the case of my video, and then you're selling covered calls once you get put the stock, and so. But the other thing you're doing is buying low and selling high, right?
yep,
So if you have an uptrend market where you're kind of taking the initial trend that day and you are selling into that, aren't you kind of on the wrong side of the market more often? Just not necessarily that you're wrong, right? Because you have that advantage of the mean reversion. But do you
yeah.
feel like you're constantly shorting the market when you should be
Oh,
selling credit put spreads?
yeah, the same. Yep. So I do actually realize that quite a bit too. And for
Yeah.
me, that's what made me shift to the 1 DTEs and the two
Uh,
DTEs a little bit
yep.
more was
Yep.
the idea that, I like to follow the psychological levels. So 4650, 4600, 4550, 4575, right? Like
Yep.
those 25-point increments. You always see they have more volume and open interest on the options chain too. And 70% of retail traders always flood to the earliest expiration.
Right.
So that's what I find to be very, very interesting too, right? So
Yeah.
combine all those together, and I was like, wow, I can actually reduce some of this volatility by looking at what the EM is about an
Yeah.
hour and a half until close, and then putting my trade on for the next day,
Right.
right? and collecting that volatility decay overnight to where the EM drops from 22 to 17.
Mhm.
And hey, if the market doesn't move, I still collect like 50% of the premium.
Right.
If it moves in my favor, then I'm pretty much in the clear. And then the other example is if it does move really hard against you, right? That's when I begin to hedge and also look at, okay, I'm going to keep this on for X amount of time or roll it early. And, that's a lot of where much of my success has come in for the previous year for most of that time. So,
But you must love a down open in a bull market, right?
oh
So
yeah,
so
which
that's
we
got to be
haven't
like the
really.
ideal feeling because you're like, I'm riding the overall trend and I get to be contrarian and mean reverting for this day rather than that feeling of like, why do I always have to start with a credit call spread in a bull
Yeah,
market, right?
100%.
Yeah, yeah.
Yeah.
So that is fascinating. Yeah, because I always tell people like, what are the general rules of thumb? And it's like be short premium more than your long premium. Not that being long premium is necessarily wrong. A lot of people, but don't only do that. Obviously, an ideal situation of somebody trading a million options is to have a little bit of balance between the two. But
Absolutely.
at the same time, it's like, markets go up over time. You might catch a bear wave, you just like you might catch a VIX move to 40, but it's not going to last very long. Bull markets last a lot longer than the bear markets do in time, right? They might cover the same amount of ground, but a bear market goes like that and a bull market goes like that. So it's pretty fascinating. All right, well, Logan, this was awesome. And if people want to check out more of your stuff, like what's the best place to go find you?
Yeah, just YouTube, honestly. I
Yep.
really don't use too much other and Discord, YouTube and
Yep.
Discord.
And
So,
whenever I'm Googling you to find you, I just put in Logan Laj.
yep, Logan Laj, just Logan and then LAJ.
And you'll
So
find
that's
them.
the handle. It was always easier to just shorten it and just make it really concise. So
Yep.
yeah, just my personal brand, Logan Laj. And
Yep.
I do have like Instagram and Facebook and all that, but I barely use them. So
Yep.
it's
Yep.
just, I like to just trade and be around the community of trading and leave all the pictures of people's kids to what they want, and they
Yep.
post in what they're doing.
Yep.
They always, I can always leave that aside and, all their family gatherings. So
Yep.
I prefer just sticking to YouTube and Discord and just keep into the trading community. So I think it's a lot of fun and
Oh, perfect. And so Logan does have like a really cool community, serious people that are there for serious reasons and they're trying to learn together. And
yeah,
again, just to reiterate, Logan has a particular style of trading. It might not necessarily be exactly what you as a trader in the audience wants to do, but it's interesting to kind of hear that perspective and hear that mentality. Even like, when Logan got into the Iron Condor thing, I would actually, push back a little bit on that, as particularly for certain styles of traders. And I don't know if it's because I'm lazy and I don't want to watch the market all day long, and I don't want to have
yeah,
to take like sort of, react. I don't want to have to react to the market necessarily. That is sort of like for a certain mentality. It's like, listen, I'm not even going to pay attention. I'm going to do an Iron Condor or whatever at these levels, and I know I'm going to be wrong 1 out of 4 days, whatever it is, and I'm
yeah,
cool with that. And then the other days, I know exactly how to manage it, and I'm not going to panic. Whatever it is. What's going to be cool about this series, and Logan will be back on, and we'll talk about we'll nerd out on some other things, but it's sort of like use some of this knowledge, find some of this useful in your own trading. All right. Well, thanks for joining, Logan.
you got it. I
Yep.
appreciate you taking the time to have me on. I really do.